It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. Here with me in the KFG studios, Josh Gregory, and special guest back again, CPA Ryan Fair.
That's right. It is episode 2 of our series on the biggest tax questions from the pandemic. And as Mike mentioned, we're joined once again by Ryan Fair, who's going to be tackling some bizarre tax questions today. So we're hitting that and more on today's episode.
We took it easy on Ryan last time. I mean, if you watched or listened to the round one of this 2-round match, we took it easy on him. We didn't stump him.
I survived. I don't know if you took it easy, but
we're going to stump him today. We got some great questions. My favorite tax questions from the pandemic we're hitting coming up. If you have a question for us, we'd love to hear from you. You can reach out to us a few different ways. Call or text us 574-222-2000. That's 574-222-2000. Online, wisemoneyshow.com. You can submit questions right there on the right. And then most people, though, leave questions, get several a day on the YouTube channel. So go check that out. Go to YouTube, search the Wise Money Show. Follow us there and turn on notifications and leave questions right there. And we'll either answer them right there or we'll put them in the queue for an upcoming program. So, all right, Ryan, we're glad to have you back. We're going to try and stump you. This, to me, we're going to start with, I think, the most, we might kick you out of the studio based on how you answer this. This is the most common tax question, in my opinion. Outside of, is that stimulus taxable, which the answer is no. Is that extra unemployment taxable, and the answer is
yep.
All right. I had to work from home for part of the year.
Or the full year.
Yeah. My office shut down. We switched to working remotely. Do I get to claim the home office deduction?
So, Mike, I see what you're up to. You brought me back to do your dirty work. The answer is no, everybody.
Get out. Get out,
I know.
Ryan. Get out of here.
So no, the home office deduction for employees of a company went away a few years ago. So if you're just a regular W-2 employee, office shut down, hey, go work at home, I'm sorry, there's nothing home office related on your tax return that you can deduct.
Even if you have legitimate expenses, like it's costing you something to work from home.
Yep.
Maybe you had to go soup up your internet connection or something. There's nothing happening for you if you're an employee, you're saying.
Not from the IRS, not on your tax return.
Okay, we are going to get into this because there are folks that hung a shingle. Like they started working, hey, I lost my job, I'm going to start doing sales, or I'm going to start doing 1099 type work. So I want to get into the home office, how that stuff works. But with that bad news, I just want to hit a couple of things here. So you had to start working from home, and you realized your internet speed is not up to snuff, so you needed to buy more internet.
Yeah.
Is that deductible anywhere?
Not by you as an individual taxpayer. You could beg your employer and have, I'm going to say this a lot, but an accountable reimbursement plan for the company, and the company can reimburse you for those expenses, and they can deduct it, but not you as an individual.
So that's a phrase, that an accountable reimbursement plan.
Correct.
Maybe a common place that you would encounter something like that is if you were doing some driving for your employer and you're deducting your mileage, or not deducting it, but rather getting reimbursed for your miles. That's a type of plan, but you're saying that can exist in other areas as well.
It can.
For internet access being an example.
Yep.
Okay.
Yep. Or, I mean, it could be anything from office supplies to internet to some of those, various expenses.
So the idea being then that you can't take a deduction, But your employer would be able to write it off as a business deduction, you're saying?
And it's a tax-free reimbursement for you as an individual.
Okay. And so the same would be, but I'm just hitting this so that your mind doesn't wander too much. Same would be for a second monitor or for a keyboard and mouse, like those sorts of things to functionally get maybe a better chair at the home office. All of that stuff, there's no place to deduct it. Your best option is get your company to pay for it and get reimbursed.
I'm glad, though, that you recognize that this used to be an option to write these things off. In the effort of simplifying the tax code and everything, it went away. It'll be interesting in the coming years to see if this gets lobbied back into the tax code with more and more people working from home as employees. I wonder if we're going to start getting these write-offs coming back again. Stay tuned, I guess, would be the comment there.
Okay, so now what if you are self-employed?
So self-employed is a totally different story. So
let's say you were renting a place and you're like, I'm not renting this little, this little, I was renting an office at a local office complex, and no way, I'm not doing that anymore. I don't need it, and it's expense and whatever. I'm not doing that. I'm now going to work out of my house.
So work out of your house. So the way that this normal home office deduction works is if you have a part of your house that's used regularly and exclusively for your business or some part of your business operations and you're self-employed, you can deduct those home office expenses. So the way that it typically works on your tax return, there's two different ways. There's either the simplified method or the regular method. And simplified, it works a lot more like when you get reimbursed for your mileage, where the IRS came out and said, for every mile that you drive, we'll allow you to get reimbursed X amount from your employer. If you're self-employed and have a home office, the IRS has assigned a value of $5 per square foot up to 300 square feet. So do the math there, that's $1,500 deduction if you use the full 300 square feet. And that is the amount that will allow you to take as a tax deduction on your Schedule C as a sole proprietor business. So that's the easy way. They call it the simplified method, literally, from the IRS. The other option is much more complex, but could lead to a larger deduction. And it's a lot more record keeping, where you do have to actually keep track of all of your utilities, your mortgage interest, property taxes, homeowners insurance, improvements, depreciation. All of that stuff is involved if you're doing the regular home office deduction instead of the simplified.
So that's the more traditional approach that everyone used to have to jump through those hoops and calculate all those different expenses, track them and everything.
Exactly. And it is still common, but a lot of people opt for the simplified method. And the other, it's still based on square footage also. So either method you choose, you have to keep track of the square footage. So if your office area is in a 10 by 10 room that's used regularly and exclusively for business, that 10 by 10 room is 100 square feet. Your whole house is 1,000 square feet. So 10% of your household utilities, 10% of your mortgage interest, 10% of each of those expenses is what gets deducted as a home office deduction.
As opposed to the 5% simplified.
$5 per square foot.
Oh, thank you for correcting that. Okay.
Yeah.
Interesting. Now, okay, so you kind of paused and were really clear to use these two words, regular and exclusively.
Yes.
I mean, how rigid is it that this space really is just a home office and it's not also a spare bedroom or storage or something like that?
Yeah, you can go back and read different IRS audit cases, and it is pretty rigid. So the IRS, so the exclusive part is what rules a lot of people out from being able to take the home office.
You got a spare bedroom in there, or a spare bed in there. Yeah.
Right. And so if you have guests that, 3 times a year for holidays, they come and spend a couple nights in that spare bedroom, it's no longer exclusively your office. It's also a spare bedroom.
Can I just sum all of that up, Ryan, to that was bad news. Thanks for being mean to all of us. But we've got great questions about if you fixed up your house, if you rented your house. We were going to try and stump Ryan. So we got that and more coming up on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. You're at the Wise Money Show channel. My name's Mike Bernard. Josh Gregory and Ryan Fair with me in the studio today. If you're not a subscriber, hit that subscribe button, turn on notifications, and smash that thumbs up button. What we're doing right now, this is our 1 hour talk show, airs right here on this channel, 10 a.m. Eastern Time, every Saturday morning. Also on our podcast, wherever you listen to podcasts, check it out there. But then also on this channel, all throughout the week, you've got extra nuggets of financial wisdom that air every single business day, and helping you apply what's going on in the world of finance to your financial life. So make sure you hit that subscribe button, turn on notifications. If you like the content, smash that thumbs up button. Thank you very much. Crazy. I don't know if they could go back to home office deduction. We'll see how well this ages. I'm saying no. Josh, you think maybe?
If you have these huge employers that are sending everybody home to work, and many of them, there are a lot of CEOs that have gone on record as saying, I don't think we're ever going to go back to a major corporate office where everyone kind of commutes in and we all congregate together. If that's true, if there's enough of them, I wonder if you start having more big employers kind of lobbying to get this pushed back in, or Congress starting to recognize that, hey, we've got people with legitimate expenses at home and they don't get any benefit out of it.
You're applying too much logic.
Yeah,
I still say no.
I agree.
What do you think?
I get it.
I say no.
I mean,
I see where Josh is going, but I don't think they'll bring it back.
In a rational world, you're right. I think that happens. But what's the motives right now of the IRS? I think they just
or the
motives
it's not
of
the
Congress.
Congress, and it just feels like there's a natural drift always for more complexity in the tax code, not less.
Yeah.
I mean, we had a little stretch where we tried to simplify the tax code, and it's a new regime now. And
this coronavirus stuff that we're going through makes me wake up and listen to that Rush Towards Retirement episode you guys did a few weeks ago.
That's right.
Don't get any ideas around.
Yeah, if they keep doing this garbage, I think I'm going to be forced into retirement.
All right, so let's talk about home improvements, and let's talk about turning your house into a rental. That probably covers the full segment. We'll see. Maybe not. If it doesn't, we'll get into the Airbnb stuff and any other questions. I mean, we got 2 segments to hit these sorts of questions, so you can be long-winded and talk about how it impacts other things. And all right. Are there still those, energy efficient tax credits out there? And with all the work you did to your house during the pandemic, do you get any tax benefit for that? We're going to ask that question to CPA Ryan Fair. Ryan Fair.
Yeah,
that's great. Ryan Fair. Well, he's not fair.
Subliminal.
All right. This is the Wise Money Show with Corhorn Financial Group. Thanks for being here. My name's Mike Bernard. Here with me in the KFG studios, Ryan Fair and Josh Gregory. Every episode of the Wise Money Show is on the YouTube channel. Check it out. Go to YouTube, search the Wise Money Show, subscribe to it, and leave questions, comments there as well.
Hey, I will say, you are more intimidating with a beard these days.
That's the new Ryan. Coronavirus.
The new image.
New image. I bought a Harley this year.
Oh,
got a little facial hair I've never had before. It's a whole new
Can
Ryan.
you deduct the your beard products, your beard moisturizers, and all that stuff?
Maybe for this recording purposes, I could.
No,
don't look for any expense reimbursements from me. I might turn some in to the company, though.
All right, so let's talk about something a little more practical. Although sweat pants and not shaving. Yep, that definitely became more popular during the pandemic. The other thing was I'm sitting around in my house all stinking day. Gosh, that needs to be fixed up. I'd love to paint that room, or we should probably do this. And we went from home renovations being like stopped in their tracks to being you can't book anyone. They're booking out years and years.
And charging whatever they want, It seems.
So good friend of mine came out and had to put in a new furnace for the Bernards. It was a solid 24 years old, and it went on and off, and so finally it was like, okay, this thing just needs to be replaced. And we got one of those old energy efficient ones, Ryan. So we'll get into.
Sounds expensive.
It was expensive. Yeah. Good thing we do delayed spending. So
nice.
So whatever. And if you're not sure what that means, check it out because it helps. It helps. It wasn't a financial crisis. But are there still tax benefits? Let's say furnace. Let's say windows. Let's say roof type stuff that's energy efficient.
Yeah. So there still are some energy credits hanging out there. So there's two different ones. So there's one called the non-business energy property tax credit. This is the same one that's been around for a long time. So actually 2005, this one started, and certain stuff. So like we said, the windows, the furnace, air conditioning, water heater, those are the biggies that this credit applies to. Windows, for example, it's 10% of the cost you can take as a tax credit. So
up to a certain limit?
Yeah, up to $200.
Oh my goodness!
So
they might as well say 1% of the cost of the windows.
200 total for the year, or is it just
so
that
it's
category?
even better than that.
Lifetime.
It's the lifetime of this credit. So all the way back to 2005. So Mike, if you moved into your house in 2005, decided to put a couple $1,000s worth of new windows in, and then you do some more windows this year, you've already maxed out your $200 window lifetime credit, so you don't get to take any more. Same thing for furnace, air conditioning. There's different dollar amount thresholds for those. It's like, $150 for one of them, $200 for the other. But all of these combined max out at $500 over the lifetime. So over the last 15 years now, we're talking. So many people have already hit their limit by doing windows or a furnace within the last 15 years or air conditioning the last 15 years.
How in the world would you track that and remember that?
That's a great question.
Can you, so just off the record.
Uh-oh.
Can you double dip? Like how, like if you did TurboTax and then you switched to H&R Cube and then you said, let's go to KFG. And so over these 15 years, you've had a few different tax preparers and now you're here with us. Could you know? Does the IRS know?
I would think the IRS has the ability to know because obviously it's reported on that tax form. Have I ever seen a notice as a result of somebody double dipping? No.
Oh, there it is.
That's not saying go for it.
You're sounding a little too optimistic or opportunistic here,
seems
Mike.
Crazy that
it is crazy.
$200 or a cumulative $500 over 15. That's it.
Yep.
That's crazy.
So the other ones that are also that all that stuff we were talking about is called the non-business energy property tax credit. The other one is the residential energy efficient property credit. So this one's totally different, but it applies to all of the really expensive stuff. So solar, geothermal, so solar electric, solar water heating, wind systems. If you have a small wind system you put in, your own windmill for energy production. This credit is larger, but obviously the expenses are much more than just putting in some windows. So for 2020, it's a 26% tax credit.
Whoa.
Yeah. So we're talking big dollars.
I think a lot of people tried doing solar this year. I think so. That might have been a boom.
It could have been. I haven't seen very much in past years.
Well, because we don't have the sun around us.
Solar doesn't work in Indiana.
No, we actually do have one of our local farms here, just east of us on the highway, turned their farm into a solar farm.
Yeah.
Yep.
But that's separate than what you're talking about.
Yeah. And it does go down to 22% for this upcoming year. If you're thinking about doing it in 2021, it goes from 26% down to 22%. It's just
that's been declining over time, right? I mean,
correct.
It seems like there
was
a
started
day
at 35.
That's what I was remembering too.
The problem though is, aren't these utility companies are still charging you a normal amount? Like anyway, that's a topic for a different show.
Yeah.
I mean, you guys try to keep your eyes and ears open and try to keep tabs on the changing winds with the tax code and everything. But do you hear any rumors under this new administration, which has been pretty public about being very environmental friendly and everything? Do you see this maybe becoming more lucrative or a bigger incentive in the future?
Yeah, it definitely wouldn't surprise me, just because what you're saying. The new administration's very, very environmental conscious, friendly. They've come out, in their first few days of the new administration, they've come out and said as much. That they're, they some of the very first executive orders were, overturning
related.
Environmental stuff. So yeah, it wouldn't surprise me a bit if the credits go up.
Okay, speaking of house, so we've got a few other questions here related to taxes in your house, but what about this one? You're sitting around your house, you're hearing all this craziness that, no one's buying houses. Oh my goodness, everyone's buying houses. Oh my goodness, we got to move. Let's turn this house into a rental. And you start looking at, hey, all right, well, what needs to be fixed up before we would turn this thing into a rental? And you start getting to work while you're living there.
Yeah.
Do you get to deduct those expenses because you were planning on turning that house into a rental?
So again, I'm the bad guy here, Mike, but no, you can't just start deducting them on your tax return. What you can do, if you're, let's say before you turn it into a rental, you need to do a bunch of improvements, fix it up, put a new coat of paint on everything, new porch, new deck, new whatever, appliances. You can keep track of all of that stuff while you're doing it, but you don't actually get to deduct anything until the real estate is put in service as a rental property. So it can increase your basis for depreciation purposes. You could write it off in that manner, but not while you're living there. That's just a personal expense. Or even if you moved out and lived somewhere else while you're doing the improvements, it's still not put in service as a rental, so you can't just start deducting everything.
The other big question connected to this is we bought a property and turned it into an Airbnb, or we took our existing house and started doing some Airbnb. I mean, that's another theme we're going to be talking about here. It just coming up in a second, we're going to ask Ryan about that. And we've got a few other questions related to, the confusion with taxes and everything else going on in the pandemic. So lots more to come here on Wise Money Show with Korhorn Financial Group.
Jared's out of the office today, so everybody's wondering.
You might just shoot a message and say 11.
Okay, yep.
No, I didn't know Jared was out, and he didn't say anything.
Chattanooga. Yeah.
What's down there?
Meeting up with family members, kind of converging.
Whiskey.
Nice.
Whiskey.
Bingo.
Bourbon. Bourbon's Kentucky. Whiskey's Tennessee.
Moonshine.
Well, it's weird. All right.
White lightning.
Okay.
That's West Virginia.
Oh.
Moonshine.
I don't know if this is going to hit the full segment here. So if there's anything else related or any other
Airbnb stuff?
Yeah, I don't know. We'll see. We'll see, and then because if we can be done with these questions during this segment, that would be good. So 2020 was the year of Airbnb. I mean, can you believe it? I would have said there's no way. Everyone's got germs. I'm not going into someone else's house and staying. Boy, was I wrong. We're going to be talking about that as it relates to your taxes right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. Here with me in the KFG studios, Josh Gregory and special guest CPA Ryan Fair. Every episode of the Wise Money Show is on podcast. Go check it out wherever you listen to podcasts, whether that's Apple Podcast or Spotify, wherever. Go search it. Search the Wise Money Show with Korhorn Financial Group. Subscribe to it and rate the program. We appreciate that. All right. So can you believe this? I watched the clip of the founder, one of the founders of Airbnb, when the stock listed and started trading, and he was being interviewed at the very moment, 9:30 a.m. Eastern time, And the utter shock on his face was, I would say priceless, but it's not priceless. It's $110 billion. Let me
So he
just
was
tell
watching
you.
his net worth like triple right before his eyes.
Yeah.
On live TV.
As Kevin would say, I'm glad he was wearing his brown pants.
Oh my goodness.
Airbnb, a company that doesn't own anything, has a market value of $110 billion. Now, let me tell you, that market value is higher than the 6 largest hotel chains, Marriott and Hilton and Hyatt, Wyndham, right? It's higher than those 6 combined. So you Airbnb'd your house. Okay, let's first take it. You can take this from a tax standpoint in 2 different ways. You could, okay, I bought an Airbnb. I bought a house that I'm going to Airbnb, never lived in it. But let's first take, okay, I started Airbnb my place. I know we got lots of fans of the Wise Money Show on the West Coast and down on the East Coast and down in Florida. And so you took your house and you're like, I can rent this thing out for a little bit. How does that work from a tax standpoint? The income and then expenses, how does it work if you start Airbnb your primary residence?
Yeah, it's kind of goofy tax-wise. It's a lot more work and record keeping, but it can be very lucrative too, or fairly lucrative also if you're doing it. So we've been kind of used to this for many years around here, being close to Notre Dame. We see a lot of people that rent out their houses for the weekends of Notre Dame home football games. That's kind of the best case scenario for taxpayers. IRS has a rule that if you rent it out for less than 14 days per year, or less than 15 days per year, so 14 or less, that income is all tax-free. You don't have to report it as income. You don't have any additional expenses to deduct. It's crazy.
That is how it becomes lucrative, by the way.
Mm-hmm.
That, I mean, you could make 10, 12, 15,000 depending on how nice your house is and whether or not Notre Dame's playing well.
Yeah.
But that's huge income. And
Right.
for it to be tax-free, what else can you say that about in your financial life other than that?
Yeah, no, that's wild.
Your Roth IRA.
HSA.
There you go. There are some, but this makes it a pretty sweet deal that a lot of people, it gets their attention, and why more people are pouring dollars into their houses to maybe put themselves in a position to tap into some of this income.
Yeah, so for just the regular family that, again, Mike referenced the, nicer locations that people just want to go vacation, Florida, West Coast, South. It's a bunch of record keeping that is reported on most cases Schedule E. There's certain criteria that you want to make sure that it goes on Schedule E, which is the normal rental real estate tax form of your tax return. And then you get to start taking off expenses based on a number of factors, primarily the number of nights that the home is rented and versus the number of nights that you use it personally. And a fraction is developed, and then you get to take a fraction of your utilities, mortgage interest, property taxes, all of that stuff you get to deduct off of the rental income that you've received from Airbnb. It's
how would someone who is getting some rental income like this, how would they know that they do get to write off some out-of-pocket expenses versus have to deduct it over time? Because that throws people off. They might go get the new furnace or do something to update or enhance their house, and then they're shocked or surprised that, wait, I thought I was going to get a write-off for all this.
Yeah, you could get a write-off for it, but not all in this year.
In that year.
Yeah, and so what you're referring to is capital improvements versus just small repairs of a property. So if it's an improvement, like you mentioned, the furnace and air, those types of expenses, roof, major expenses, that fraction stuff that we talked about does still apply, but then it gets depreciated over a number of years. So residential real estate, 27 and a half years that expense gets depreciated over. Now, other appliances and stuff like that could be shorter term. It all varies depending on what the actual expense is that you're putting in.
Okay, so let me take that a step further. For your house that you Airbnb, I need a nicer stove. So you buy a new stove for your house. You live there.
Right.
But you say, well, it's because, I'm going to start Airbnb-ing my house, and I don't want this pepperoni that's been charred at the bottom of the stove since 1983.
Maybe I'd recommend
to be
cleaning
there.
your stove.
That's the first place to start.
I'll just replace
No
it.
tax deduction.
I'll
but
just replace
clean
it. So do you get to deduct that?
It's fractional. So
fractional, okay.
So again, it's complicated.
So
based on
sounds
number of
like
nights that you're, if it's your primary house and you're renting it out for 30 nights, but you live in it the other 335, that's basically, whatever the math, 10% roughly of that stove is a business expense that you depreciate.
Depreciate it, so that's the slow over time. So over, what'd you say, 27 and a half years?
Where that's for the actual real estate part.
Okay.
So 5 years.
5 years then.
for the
Yeah.
A lot of stuff
That
is
makes sense.
5 or 7 years, but still 10% of that $2,000 stove or whatever it's not a huge deduction, so that's where don't let the tax, what's that saying? Tax tail wag the dog. Yeah.
Okay, so speaking of something sort of wagging the dog is their interest rates have dropped to zero.
Yeah.
Rental, or at least residential properties have gone up through the roof. Lots of people are looking at buying rentals and buying in spots where they can just Airbnb it. So if you did that in 2020, what sorts of tax benefits are there? You get to start deducting it, and how does that work if it's not your property, like your personal residence?
Yeah. So no, that's actually a lot easier from the record keeping standpoint and from a tax standpoint. We're not worrying about the number of nights and all of that stuff. It's exclusively used as a Airbnb rental property. So you deduct 100% of the utilities, 100% of the paint and repairs and mortgage interest, property taxes, insurance on the property. All of that stuff is subtracted. You still do have to depreciate the actual cost of the property. So like the house itself, that's where we talked about the 27 and a half years is the depreciation period. If you're doing, furnace, those kinds of improvements are also long, 27 and a half years for that kind of stuff. But the appliances, carpet, those kinds of expenses are capital improvements that typically need depreciated. But that's more like 5-7 year property that you can write off over that period.
Let me point something out that Ryan snuck in really subtly. If you're doing this because you just started Airbnb in your house or you bought one and you're just, I like doing my taxes myself, don't let that money show up on a Schedule C. Don't do it.
Yeah.
That is an enormous mistake that if you're doing things yourself, you could easily get into, or working with a part-time tax preparer who doesn't do this full-time. That'd be an expensive mistake. Work with a pro like Ryan and our team.
Yep.
All right, we've got a few other questions coming up on the Wise Money Show with Korhorn Financial Group. Okay, good. That was the third segment, right? Mm-hmm. All right. Okay. Well, we can. Ryan, you hanging?
Sure.
You hanging around? All right. So we can grab the other tax one. We can grab Gene's question, and then so we'll grab Gene's question. We'll grab the HSA question.
Right above that one.
Mm-hmm. And then maybe George's question at the top, since that's sort of related to taxes. I texted with George a little bit. Nice guy. All right, let's get into it. Thanks for being with us. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. Here with me in the KFG studios, Josh Gregory, and special guest, CFP CPA Ryan Fair. If you've missed anything, every episode of the Wise Money Show is on podcast. Go check it out. You can also find us online, wisemoneyshow.com. We got a media player right there. Check it out. You can even submit questions right there on the right. And that's what we're into right now. This has been the second show of a 2-part series on Stump the CPA Ryan Fair. You did all right. You did all right. And so obviously the pandemic brought on all sorts of changes in your life. And I'd probably argue like more change to the tax code than, I mean, any of us would have thought. All the stimulus, all of this stuff impacts taxes. And so make sure you're getting financial wisdom and working. I mean, so we would tell you, work with a professional as opposed to, just trying to ad hoc it. And then work with a full-time CPA and tax professional as opposed to just someone who hangs a shingle and works as a tax preparer for a couple months of the year. That's it. And then really make sure it's all integrated with your overall financial plan. Got a few great questions here related to taxes, not necessarily pandemic. This one's from Jean, who's a fan of the show. I've connected with her a few times. She's asked several questions. Thanks so much for listening and for your engagement, Jean. This one's back in December, and I already worked with her on this. But I wanted to air it out, even though we're into the new year, and it doesn't directly apply, but the concept applies. So here's what she said. I've got a question on timing of giving stocks to a charity. I own 100 shares of stock currently valued around $5,000. My income this year, with dividends, everything in, is around $125,000, but I'm now retired. If I use just my savings and dividends to live on next year when I'm retired, my income will only be $30,000. Should I donate the stock in 2020 when my income was high, or should I donate it in 2021 when my income's low? What are your thoughts?
Great question. I mean, we can speak to this one, even though the year has come and gone. So we can't literally look at this question as if it's a live question. It's more of a scenario that could play out again for many of our listeners here towards the end of 2021, right?
Yeah, definitely.
Anytime you come to the end of a calendar year and you've got to make a choice on, do I pull certain deductions or write-offs into this year, or do I want them out into next year? There's certain principles that can apply here. And to me, it all just boils down to the fact that, well, tax write-offs are more valuable to you the higher the tax bracket that you're in, right? And that might sound obvious, but the reality is some people don't really even know exactly what tax bracket they're in this year or what would change next year. Mm-hmm. They're just looking at tax returns just kind of short-term in nature and not looking at multiple years and so on. So, Gene, I would just applaud the fact that you were even examining 2 years side by side. That's fantastic. Obviously, the fact that we are now into a new administration, that tax laws change over time as well. That could be the other variable to pay attention to. And tax laws could, or tax write-offs could be more valuable to you just simply because the laws change over time. So in general, to me, I would have, and I'd be curious to hear what your conversation with her was about pulling that gift into 2020 when you were in a higher tax bracket. But just keep in mind that those types of gifts they're only deductible to you if you are itemizing your deductions. Maybe, Ryan, you can kind of unpack some of that for us.
Yeah, so if you itemize, that's where you deduct those charitable contributions. So where my mind was going, 2020, while she is working and has good income, the chances of her itemizing are going to be higher than when she is retired and doesn't have that high income. So the standard deduction for an individual or a filing single taxpayer like this, the chance of hitting it while she's working is higher because the typical itemized deductions that Jean or someone in her position would have, you deduct any taxes, so state and local income taxes that you pay. So all of those state and local withholdings on your paycheck show up as an itemized deduction in the year that they're paid. Add that with property taxes on her residence, vehicle excise tax, if there's still a mortgage that there's mortgage interest on, and then you throw in charitable contributions such as this $5,000, her chances of hitting that $13,000, $14,000 itemized deduction threshold for a single taxpayer would be greater in the year that she has higher income, which is where I would say take the deduction in 2020 because your chances of itemizing in 2021 are next to none, unless.
So she might not get any tax write-off or tax benefit in 2021 if she had delayed.
Correct.
I actually, so I worked with Jean on this. She is able to itemize in 2020. She was, and so when we were connecting, it was middle of December, December 16, and I said, absolutely, I would donate it if you're going to itemize, because this will help you itemize even more versus getting the standard next year. Now, I have no idea what will happen to tax rates this year, but there's another play on this, and I don't know if you saw it, but she said her income this past year before retired was $125,000. That's great income. But if she just lives on savings and dividends, it'll be $30,000. Jean, I mean, that opens you up to consider some Roth conversions.
Yeah.
Because if you're just retiring, you're young. Likely you're going to be retired for a few decades. And so if your income's only $30,000, should you consider converting? And if you're converting, then you also might be looking at, well, where can I find some other deductions to help offset some of this conversion? So that's what we're talking about with comprehensive financial planning. Retirement, cash flow, taxes. I mean, it's all connected here.
Yep, you're exactly right. And, your certified financial planner or your CPA working with your certified financial planner can help you determine whether or not you actually would have gotten a write-off here in 2021 or not. Being able to forecast what your tax picture will look like in the future, you have to make certain assumptions. And to me, relying upon professionals who know your situation and know really the areas that you can swing your tax picture, pulling additional income into this year because of doing a Roth conversion is a fantastic idea. Help you maximize those lower tax brackets.
Yeah. Okay, great question here from Steve. Also posted on this one was posted on the YouTube channel with a video where we were talking about an HSA and being on Medicare. And so here's his question. So HSA contributions stop when a policyholder turns 65, whether they're employed or not. And he has a question there because that's not true. We'll talk about that. Is there any case where you should decline Medicare Part A so that you can still contribute to an HSA? That's more the question. So, Josh, do you want to take it? There's sort of a comment that's really a question, and then his other question.
Right. So the specific question on, at age 65, you're suddenly not eligible to contribute to an HSA. That's technically not true.
That is not true.
It's the fact that you are signed up for Medicare that makes you not eligible. Now, that happens at age 65 for most people, unless you take action to prevent it from occurring.
Yeah, and so let me just geek out for just a second here. There's, if you are still working at age 65 and you've got group insurance, you're not drawing Social Security, then you're not automatically going to get on Medicare. You won't. There's nothing that automatically puts you on there. And if your group coverage, health insurance coverage, is a qualifying high deductible health plan, you just keep contributing to your HSA, even though you turn 65, no problem. But you can't deduct your HSA contribution if you have other health insurance. And that's what can trip people up. If they've got Medicare, but they also have an HSA plan, well, that means you're not eligible to deduct a contribution to your HSA. So,
if Ted Foster or Craig Weicker, some of our health insurance experts, were on this show, if this was a show about health insurance in retirement, one of the questions that I never bother to even try to keep straight in my head, I just go to them, is whether or not your employer can force you to add Medicare once you reach age 65. And I feel like, and this is foggy in my head, but I feel like it may have something to do with the number of employees with the employer. Like, the rules are different depending on what company you actually work for.
Oh, that's interesting.
So just when you think you've got it straight in your head, there's extra wrinkles that sometimes appear.
Well, I'm going to throw a couple at you with this. So let's go to Steve's second question. That is there any case when declining Medicare Part A is advisable? Possibly. I mean, possibly in this very scenario. if for some reason, if you're working and drawing Social Security and you're going to be thrown into Medicare Part A as soon as you turn 65, but you want to make sure you can still contribute to an HSA, then maybe you decline Medicare Part A. Here's the other wrinkle, though. Where this normally comes up about declining Medicare Part A is you have a spouse who's still working, and they've got a high deductible health plan, and they're doing family coverage. So spouse is working, and so you are turning 65, and you're on Social Security, so you're going to get Medicare Part A automatically unless you do something. But you've got this family coverage, you've got this group coverage. If you're not the employee, if your spouse is the employee and they've got family coverage, you can sign up for Medicare Part A, and your spouse can still contribute the full family amount to the HSA. That's the only way you can double dip and contribute to the HSA, but also have other health insurance.
Interesting.
So crazy. That is absolutely nuts. So, all right, great question there. Okay, so quick. Oh gosh, let's see. I don't even know if we've got enough time for this here from George. We're going to sneak it in. Well, here, how about this? George asked a question, and we'll leave it up here. But the 5-year rule for IRA, for Roth IRA. So, Josh, really quick, can you explain the 5-year rule for the Roth IRA?
Well, I think the basic gist of it is just simply that when you convert money from an IRA to a Roth IRA, you're moving it from a taxable account to a tax-free account, so that when you get into retirement and you start drawing off of that Roth IRA, it's all tax-free income to you. But there's big ifs attached to that, and it's quickly that you have had that Roth IRA open for at least 5 years,
yep,
and you're over age 59 and a half. And that word "and" is the most important thing to tuck in there.
So there are 2 different 5-year rules with the Roth IRA. Work with your CFP on that. We'll get into George's question hopefully next week on the program. But that's all the time we have for today. Thanks, Ryan, for being here again.
Thank you.
On behalf of Ryan and Josh and everyone at KFG, have a great weekend. We'll see you next Saturday for Wise Money with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.